Imagine a global tug of war. Okay. But instead of ropes, we're pulling with economic policies.
Right.
And every single tug sends ripples, sometimes, honestly, tidal waves, through the world's financial markets.
Mm-hmm.
Today, we're plunging into a really high-stakes conflict that's fundamentally reshaping how currencies behave globally.
That's exactly right. We're talking about what we're calling the Great Divergence.
The Great
Yeah,
Divergence.
this deep dive is all about unpacking this escalating conflict between the United States' aggressive protectionist trade policies, think tariffs,
Right? The tariffs.
and the increasingly divergent, often reactive monetary policy stances of other major global central banks.
And our mission here really is to cut through the noise. We want to give you a shortcut to being truly well-informed on this complex interplay.
Yeah, so you'll understand how these macroeconomic forces are creating this highly volatile environment.
And the US dollar. It's right at the very epicenter.
Absolutely. We're going to show you how tariffs, which seem like, a straightforward tax on trade,
Yeah, just a tax.
actually set off this chain reaction of profound secondary impacts, specifically forcing global central banks onto wildly different paths.
And we've pulled together a lot of information for this.
We really have. We've cast a wide net for insights today. Our sources include comprehensive Forex market analysis, top financial news like Bloomberg, Reuters, the Wall Street Journal,
The big names.
direct communications from central banks, the Fed, ECB, Bank of Japan, Reserve Bank of Australia, Bank of England.
All the key players.
Plus, we've pulled in hard data from CME Group futures and the CFTC commitments of traders reports, which, track how the big players are positioned.
Okay, so we see where the money's moving.
Exactly.
Yeah.
And even sentiment analysis from platforms like Twitter and Reddit.
So the core idea we're grappling with today isn't just about those trade taxes themselves.
No, not just the taxes.
It's about how those taxes are forcing central banks worldwide to make dramatically different choices.
And what those choices mean for the major global currencies.
Okay, let's unpack this then. The U.S. has really turned up the heat on trade tensions.
They really have.
What are the key threats emerging from these tariff decisions, and who's really feeling the pinch?
Well, what's truly fascinating here is the dual impact these tariffs are having. They're creating pressure both at home and abroad.
How so?
The U.S. has threatened to escalate tariffs on most European Union goods to an eye-watering 30% by August 1st.
30%. Wow.
Yeah, and they've already imposed new levies on key trading partners, including China, Canada, and Mexico.
Okay, so let's start at home. What's the immediate fallout within the U.S. from these decisions?
Inside the U.S., these tariffs are definitely stoking inflationary pressures, no question.
You're seeing prices go up.
Businesses across various sectors are reporting widespread increases in their input costs, and naturally, they're passing those costs directly on to consumers.
Which complicates things for the Fed.
Massively. It complicates the Federal Reserve's policy path considerably.
Right.
It's challenging those earlier market expectations of imminent rate cuts.
Right, everyone was expecting cuts.
And it introduces the possibility that the Fed might actually adopt a more hawkish stance to combat this tariff-induced inflation.
Hawkish meaning potentially raising rates or holding them higher for longer.
Exactly. And we're even seeing significant political pressure and media speculation around President Trump potentially dismissing Fed Chair Jerome Powell for not lowering interest rates.
Which adds a whole other layer of uncertainty.
It adds an element of political risk to the Fed's independence. Absolutely.
So if that's the picture at home, how are these tariffs affecting everyone else, the trading partners?
Well, for the affected trading partners, these tariffs are weakening their economic outlooks. Simple as that. They directly threaten export-driven growth.
So that external pressure forces their hand.
It compels their central banks. They're talking about the European Central Bank, the Bank of Japan, the Reserve Bank of Australia,
The ECB, BOJ, RBA.
to adopt more cautious and overtly dovish stances. They need to support their respective economies.
And dovish means leaning towards easing policy, cutting rates.
Precisely. And this policy response inherently weakens their currencies relative to the U.S. dollar. It's a very direct cause and effect.
So if we connect this to the bigger picture,
Yeah.
what does all of this mean for the mighty U.S. dollar? It sounds like it's being pulled in two very different directions at once.
Precisely. That's the core tension. On one hand, the U.S. dollar is strengthened by its relative economic resilience.
We saw some strong data recently.
Yeah, we recently saw strong June retail sales up a healthy 0.6% month over month against a forecast of just 0.1%.
That's quite a beat.
And initial jobless claims fell to a low 221,000. Plus, it's bolstered by that potential for a hawkish Fed.
Right, fighting inflation.
And its traditional role as a safe haven asset amidst global uncertainty. When things get messy, people buy dollars.
But on the other hand,
Simultaneously, however, the USD is threatened by the long-term consequences of the global instability its own trade policies are creating.
like what?
Well, this includes the specter of a potential global recession and a significant long-term development. Reports that China is actively stockpiling gold
Why gold?
as a strategic move to reduce its reliance on the US dollar as a reserve asset. That's a big shift.
This raises a crucial question then. What's the single biggest risk here for the global financial system as this great divergence unfolds?
The primary risk, and it's a substantial one, is a policy misstep by a central bank.
How so? A misstep in which direction?
It could mean either tightening monetary policy, raising rates right into a tariff-induced economic slowdown,
Okay, choking off growth.
or easing too aggressively and inadvertently fueling a disorderly currency devaluation, basically losing control. This great divergence between U.S. policy and the rest of the world will truly be the defining feature of market dynamics for the foreseeable future.
Okay, let's look at how central banks are actually responding. How are they navigating these choppy waters?
We're seeing very clear signals across the board. Let's start with the Fed. Their June FOMC minutes reveal a committee deeply focused on managing risks and uncertainty.
They sound cautious.
Very. Their beige book, which is a summary of economic conditions across the U.S., noted a neutral to slightly pessimistic outlook among business contacts. They are clearly wary of the inflationary impact of these tariffs.
Okay, so the Fed is cautious. What about across the pond, the European Central Bank?
The ECB has adopted an explicitly dovish and cautious tone. Very clear.
Dovish meaning leaning towards cuts.
Yes. Executive Board member Philip R. Lane stated that the high uncertainty around trade policy necessitates a data-dependent, meeting-by-meeting approach, but one that is clearly skewed towards easing.
Have they acted already?
They have. They enacted a 25 basis point rate cut on June 5th.
Okay, so the ECB is easing. What about Japan?
The Bank of Japan, Governor Ueda, has maintained a cautious view. He's worried about the potential negative impact of U.S. tariffs on Japanese corporate profits.
So that means,
It suggests that any planned rate hikes there will likely be delayed, still very much in easing territory.
so it's clear that major players like the ECB and BOJ are charting their course based on these tariffs. How are other significant economies like the UK and Australia adjusting their own monetary compasses?
Well, the Bank of England faces a real dilemma, a tricky spot.
Why is that?
Well, annual wage growth remains stubbornly high at 5.0%.
Which fuels inflation.
Exactly. But the unemployment rate has ticked up. So this complicates their rate cut calculus, especially after a recent hotter-than-expected inflation report.
Caught between a rock and a hard place. Growth worries versus inflation.
Precisely. And for the Reserve Bank of Australia, the RBA.
Yeah, what's happening down under?
Disappointing jobs data. Unemployment rose to a multi-year high. That has all but solidified market expectations for an August rate cut there.
Okay, so Australia leaning towards cuts too.
Definitely.
If we connect this to the broader market context, what's the backdrop against which all these central banks are operating? What's the general feeling?
Well, you have to remember, global stock markets are still recovering from that sharp tariff-induced crash we saw back in April.
Right, that was nasty. U.S. indices down over 9% in 2 days.
Exactly. So the overall environment is one of fragile stability, I'd say, with the looming trade war casting a long and, frankly, unnerving shadow over everything.
Now, this is where the raw data really brings it home. How do the hard numbers, like central bank rates and futures market positions, truly reflect this complex picture we've been painting?
Yeah, looking at the data side by side reveals stark divergences in policy. It's quite striking.
Give us the numbers.
Okay, the Fed's overnight policy rate is currently 4.33% effective. Their stated bias is neutral to cautious.
Okay, 4.33%.
Now, compare that to the ECB's refi rate at 2.15%, already showing a dovish, data-dependent bias after that June 5th rate cut.
Market difference. And Japan.
The Bank of Japan's policy rate is a mere 0.50%, with a decidedly dovish and cautious stance.
Wow, 4.33 versus 2.15 versus 0.50. That's divergence right there.
That is the divergence in rates.
But what about how the big players are actually positioning themselves in the markets? That's where the rubber meets the road, right? Where the real money is made or lost.
Exactly. And the futures data, specifically the Commitment of Traders report, the COT report, tells a fascinating story.
What does it show for the U.S. dollar index?
For the USDX, we see leveraged funds that hedge funds, speculative traders, they are net long, betting on the dollar going up.
No.
But asset managers, large institutional investors, longer-term views, they are net short.
Short the dollar, so they disagree.
It highlights a genuinely complex, almost conflicted positioning. It's not a one-way bet at all.
Interesting. What about the euro?
For the euro, both leveraged funds and asset managers are net long. More consensus there.
Okay, both bullish on the euro despite the ECB's stance.
Well, maybe longer term, or for other reasons. But then look at the yen. Leveraged funds are net short the yen,
I'm taking against it.
but asset managers are net long the yen.
Another conflict.
Exactly. This synthesis of positions, it connects all these disparate news items and central bank comments. It forms a coherent macro narrative, really illuminating the underlying capital flows and institutional sentiment, showing us where the big bets are really being placed.
Okay, so to really zero in on where these powerful macro forces are playing out most intensely, our analysis filtered hundreds of currency pairs.
Yeah, we narrowed it
Down to the 5 most compelling. We used a precise methodology, weighting factors like significant volatility that got 40%,
High volatility is key.
high liquidity, 30%, anomalous sentiment, 20%, and trending social chatter, 10%.
A mix of factors.
So let's dive into these top 5. First up, EUR/USD. Our sources describe this pair as being at the absolute epicenter of the US-EU trade dispute.
It really is ground zero.
And they reveal a massive and unsustainable conflict in institutional positioning. What do the charts tell us about this tug of war?
Well, technically, it's flashing a strong bearish signal. Pretty clear.
Bearish for the euro.
Yes, the EUR/Z has had a decisive breakdown of that rising trend channel, the one that supported it for most of 2025.
That support is gone now.
Broken clean through. While there was a minor wedge breakout on shorter-term charts, it really looks like a corrective bounce.
Wow, just a bounce.
Because the price failed to reclaim that broken trend line. It now acts as formidable resistance, like a ceiling.
Got it. What about indicators?
Key indicators like the daily RSI, that's the relative strength index, measuring momentum, are in neutral territory.
Meaning?
Meaning there's still plenty of room for the price to fall further. It's not oversold yet.
Okay.
And the MZD, another key momentum gauge, shows a bearish crossover, indicating increasing downward momentum. Plus, the price is consistently trading below its 20-period simple moving average. All bearish signs.
And for those watching the charts, what are the crucial levels that traders need to keep an eye on right now?
Okay, immediate support sits at 1.1562. That's the S1 pivot point, a calculated daily support level often watched by institutional traders.
1.1562, and the bigger target.
The most significant target for bears is the major psychological level of 1.1500.
Big round number.
Exactly. It also corresponds with historical support and, we suspect, significant potential institutional interest. It's a real market magnet right now.
And fundamentally, beyond the charts, how are the central banks, particularly the ECB and the Fed, driving this bearish outlook for the euro?
The fundamental landscape is overwhelmingly bearish for the euro. It really backs up the technicals.
Oh, so?
The ECB is explicitly dovish and cautious. Markets are pricing in at least one more 25 basis point rate cut this year, mainly because of that mounting trade uncertainty.
Okay. ECB leaning towards cuts. And the Fed.
In stark contrast, the Fed faces different pressures.
Yeah.
Resilient U.S. economic data, like those strong June retail sales we mentioned,
Right.
combined with rising tariff-induced inflation fears, are reducing the probability of aggressive Fed rate cuts.
So the Fed might not cut as much or at all.
Exactly. This widening policy divergence ECB cutting, Fed potentially holding or cutting less, creates a powerful tailwind for the USD and a significant headwind for the euro.
Makes sense.
And any upcoming weak Eurozone HICP, which is their inflation data, would just cement the ECB's dovishness even further.
Now, this institutional standoff you mentioned earlier for USD, the source described it as massive and unsustainable. Can you unpack that? What's actually happening behind the scenes with these big players?
This is critical, yeah. The latest COT report reveals something quite astonishing.
What's that?
Asset managers and other large institutional players hold a massive net long position in euro futures. Over 349,000 contracts long.
Wow, that's a huge bet on the euro.
It indicates a strong belief in the euro's long-term value, yes.
Yeah.
However,
Yeah.
dealer intermediaries, banks, market makers, often hedging client positions, hold an equally profound net short position. Over 455,000 contracts short.
So huge longs versus huge shorts, a real standoff.
It shows a market in incredible conflict. Leveraged funds, by the way, are net long, but not at an extreme level.
What's the risk here then?
The risk is, should key technical support levels break like that 1.1562 or especially 1.150,
Yeah.
that massive institutional long position could trigger a cascade of liquidation. Stop losses getting hit, margin calls.
Like pulling a rug out from under the market.
Exactly. Leading to a rapid and sharp price decline.
How fast is this momentum shifting? It sounds like we're seeing a decisive change already.
It's a structural shift, truly favoring trend-following strategies right now.
When numbers show it.
Definitely. The short-term cycle confirms a decisive shift to bearish momentum. The pair declined Angus 1.21% in just the last 7 days.
And how does that compare to longer term?
Well, that's a significant reversal from its plus 0.85% gain over the last 30 days. So the trend is clearly turned down.
What's the general mood out there among individual traders? Are they buying into this bearish story or fighting it?
Sentiment is decidedly bearish overall. Retail sentiment data shows 57% of client accounts are short, so they're betting on further declines.
Majority bearish them.
Yes, and automated sentiment analysis of social media confirms this. It shows a strongly negative score of -0.65. Keywords like downside pressure and fresh lows are dominating the discussions.
Any other factors?
Yeah, the strengthening U.S. dollar index, DXY, above 98.60 is a direct headwind for the euro. And the moderate VIX, the volatility index between 17 and 19, fosters a risk-averse environment, which tends to favor the dollar.
Is retail sentiment extreme yet?
Interestingly, no. It isn't at an extreme short level yet, which suggests there might actually be more room for downside before we see a major capitulation or reversal.
Okay, this is where it gets really interesting for our data-driven listeners. What are the advanced models like Monte Carlo and Bayesian inference projecting for URSD? What are the algorithms saying?
These sophisticated models are painting a pretty clear picture, reinforcing the bearish view.
Such as?
Monte Carlo simulations project a significantly higher probability of the price reaching that 1.1500, 1.150 zone within the next 24-48 hours.
Okay, pointing towards that key psychological level.
Exactly. Bayesian inference models, which learn from new data, have increased the likelihood of a hawkish, Fed-dovish ECB scenario playing out.
And what about order flow? Where are the actual buy and sell orders sitting?
Crucially, order flow analysis, looking at the order books, reveals a significant cluster of resting buy orders, right around 1.1500. So there's interest there.
What?
But there's a concerning lack of buy-side liquidity between the current price and 1.1550.
Meaning if it falls, it could fall fast.
Exactly. If the price breaches 1.1570, it could drop rapidly, almost unchecked, until it hits that 1.1500 level where the buyers are waiting.
Okay, let's summarize our forecast for EUR/USD.
Our forecast is bearish with a high confidence level, 9 out of 10.
Potential price zone?
1.1500, 1.162 error. What's that 1.150 level closely?
Right. Next, let's turn our attention to GBP/JPY, the volatility nexus. This pair is described as having extremely high volatility and acting as a proxy for global risk sentiment. Why is it so incredibly volatile, and what are the charts telling us?
Yeah, GBP/JPY is always a wild ride. It's a stark clash of monetary policies, fundamentally, and it functions as a high beta cross pair.
High beta meaning it exaggerates market moves.
Exactly. Technically, it's been in a powerful bullish trend, a strong move up, but it's now facing major resistance at the psychological 200,000 level.
200. That's a big number.
Huge level. And it's showing signs of exhaustion up here. We've seen an H1 channel break down on shorter time frames.
So stalling out near the top?
Potentially. However, the daily chart remains broadly bullish. It's still above its key EMA's exponential moving averages.
What are the indicators saying? RSI.
The daily RSI is at 70, which signals overbought conditions. That's a clear warning sign of a potential correction or pullback.
And Bollinger Bands.
They're wide, reflecting that inherent high volatility, lots of movement.
So we're seeing signs of a powerful uptrend, perhaps pausing or getting tired at a crucial level.
Yeah.
What are the key levels here that could dictate its next move?
Primary resistance is indeed that psychological 200,000 level, a major hurdle. For support, look at 198.20, and more significantly, the zone between 197.50 and 197.8.
Okay, 200 up top, around 197.50, below.
That's the range to watch.
And how did the Bank of England and the Bank of Japan create this dramatic clash in policy that fuels such volatility? You mentioned that's fundamental.
Right. The BOJ is steadfastly dovish, almost stubbornly so. Governor Ueda keeps signaling delays in rate hikes because of the risks from U.S. trade policy.
Making the yen weak.
Precisely. It makes the yen a classic weak funding currency for carry trades.
Explain carry trades again quickly.
Sure, it's where traders borrow in a low-interest currency, like the yen, and invest in a high-interest currency, like the pound in this case.
Ah, okay. And the Bank of England.
The BOE faces the opposite problem. Sticky inflation and that robust 5.0% wage growth, this makes aggressive rate cuts difficult for them.
So BOJ easy, Bowie tighter.
Creates a strong positive interest rate differential favoring the pound. That makes GBP-JPY a powerful carry trade candidate.
And the tariffs amplify this.
They do. U.S. tariffs on Japanese goods further weaken the yen, adding fuel to the fire for GBP-JPY going up.
How is the speculative community, the big institutional players, positioning themselves on this volatile pair? Are they playing the carry trade?
The C2 reports clearly show they are. Leveraged funds are significantly net short the yen, over 32,000 contracts short,
Betting against the yen.
and heavily net long the pound, over 69,000 contracts long. They are clearly betting on a higher GBP-JPY.
Okay, speculators are positioned for upside. What about asset managers?
Interestingly, asset managers are surprisingly net long the yen, over 112,000 contracts.
Long the yen. Why?
It could be a hedging strategy, perhaps anticipating some risk-off flows later where the yen might strengthen as a safe haven, or maybe longer-term value plays. It's a bit of a puzzle.
What about its short-term movement? Is that powerful uptrend still full steam ahead, or are we seeing that stall you mentioned?
Well, the longer-term trend is still clearly up. We've seen a 30-day gain of plus 2.05%,
Solid.
but momentum has definitely stalled recently. The 5-day performance is actually slightly negative, negative 0.26% as it hits that major 200 resistance.
So maybe entering a consolidation or pullback phase?
It may very well be entering a short-term mean reverting phase, yeah, before any potential continuation higher.
How are traders feeling about this particular pair? Given its volatility, there must be a lot of strong opinions out there, especially among retail.
Sentiment is generally bullish, reflecting the trend, but it feels stretched. There's caution due to those overbought conditions we talked about.
And retail traders.
Retail sentiment is overwhelmingly bearish. A staggering 74% are short GBP-JPY.
74% short.
Yeah, which is actually a strong contrarian bullish indicator,
Why contrarian?
because it often means the crowd is trying to fade a powerful uptrend. They keep selling into strength, and that can lead to further gains as those short positions get squeezed out.
Interesting. What about social media?
Social media reflects this tension. People acknowledge the strong trend, but are actively discussing potential pullbacks from the 200-pointed level.
And what do the AI models or predictive algorithms say about this potential pause or correction? Can they shed light?
Monte Carlo simulations show a widening distribution of possible outcomes, which reflects the uncertainty near resistance.
But is there a cluster?
Yes, there's a notable cluster pointing towards a pullback towards that 197.50, 198.00 support zone.
The key support area we identified.
Exactly, before a potential resumption of the uptrend. Bayesian models also assign a higher probability to a corrective move rather than a full trend reversal right now.
And order flow. Where are the orders?
Order flow analysis points to a significant buildup of sell limit orders just above 200.00. That's acting like a ceiling.
Makes sense. And below.
Corresponding buy limit orders are clustering in the 197.50, 198.000 support area, indicating where buyers might step back in if it dips.
Okay, summarizing GBP JPY then.
Our forecast is bullish, but definitely volatile. Confidence is a bit lower here, 7 out of 10, because of that resistance and overbought condition.
Potential price zone.
198.21, 200.50. We expect a short-term correction, maybe down to that support zone, then an eventual continuation of the uptrend towards or even slightly above 200.
Got it. Let's move to AUSDD, the fundamental bear. This pair is described as a fundamental bear, especially after some really disappointing recent data out of Australia. What's happening on the charts to reflect this weakness?
Yeah, the technical outlook for IUUSD is decidedly bearish. It lines up perfectly with the fundamentals.
How so?
The pair failed to break key resistance up at 0.6600. It had been trading within an upward-sloping flag pattern, which often breaks downwards.
And it did.
It did. Experienced a sharp decline below important support levels. The price is now approaching the critical 200-day moving average, which sits around 0.6407.
The 200 AMA is a big level for longer-term trends.
Huge level. Also, the RSI, the Relative Strength Index, shows a negative divergence.
What does negative divergence mean?
It means that as the price was making slightly higher highs before the fall, The RSI was making lower highs, a warning sign that the upward momentum was fading, suggesting the rally was losing steam before the actual drop.
Okay, clear technical weakness. And what are the key levels for this pair as it continues its potential decline?
Key resistance is now the 0.650000.6530 area. That needs to hold for the bears.
And the downside target?
The primary downside target is the 0.6400 level. That aligns nicely with that 200-day moving average we just mentioned, and also the S2 pivot point. Lots of technical confluence there.
What's the powerful fundamental driver here that's making the Aussie dollar look so weak? You mentioned data.
Yes, the primary catalyst for this recent weakness was a really dismal Australian jobs report.
What was so bad about it?
A surprise jump in unemployment to a multi-year high. That really spooked the market.
And the impact on the RBA.
It dramatically increased market expectations for an RBA, the Reserve Bank of Australia, rate cut at its August meeting. People are now talking about possibly even a 50 basis point cut.
0.5% cut. That's aggressive.
Very. And that fundamentally weakens the AUD. Meanwhile, in contrast, you have resilient U.S. economic data.
The strong retail sales.
Exactly. Which means the Fed has less reason for aggressive rate cuts. So again, that widening interest rate differential strongly favors the USD over the AUD.
Any other factors hurting the Aussie?
Yes, as a commodity currency, the AUD is also highly sensitive to global growth sentiment, and particularly China's economic health. And the overarching trade war threat acts as a further headwind. It's facing multiple pressures right now.
So it's not just the data. It seems institutions are betting heavily on this decline. Are the smart money players positioned for further weakness here?
Absolutely. The latest COT report shows that large speculators, including leveraged funds and also asset managers, have significantly increased their net short exposure in the Australian dollar.
To what level?
To a 15-week high. Yes, the smart money is clearly positioned for further declines here. They are betting on the Aussie falling.
And how strong is this downward momentum? Is it just a blip or a more sustained move we're seeing?
Firmly sustained. This is not a blip. The 7-day performance shows a significant decline of a negative 1.61%. That reflects a sharp sell-off.
Has it wiped out previous gains?
Pretty much. This recent move has actually erased the modest gains seen over the last 30 days. The 30-day change is now slightly negative, minus 0.22% overall. The market is definitely in a trend-following mode downwards right now.
What's the general market sentiment telling us about the OUD-USD? Is everyone bearish?
Sentiment is overwhelmingly bearish across market commentary and social media. Lots of negative talk.
But what about retail traders?
Interestingly, retail sentiment presents a mixed picture, which can actually signal further trend continuation sometimes.
How so?
Well, 57% of IG client accounts are long OUD-USD. They're attempting to buy the dip against this strong prevailing downtrend.
Which often doesn't end well in a strong trend.
Often not. Plus, the strengthening DXY and that moderate VIX add to the bearish backdrop for the AUD.
And what are our predictive models projecting for this currency pair? Where do the algorithms see it going?
Monte Carlo simulations project a continued drift lower, targeting that 0.6420 support zone, right around the 200-day moving average.
Okay, models agree on the target.
Yes. And Bayesian models, which we updated with that weak Australian jobs data and the strong U.S. retail sales, have significantly increased the probability of an RBA cut Fed hold scenario. The fundamental divergence theme again.
What about order flow? Is there support below?
Order flow analysis indicates a concerning lack of significant buy orders between the current price and 0.6400.
So like your USD, it could drop fast.
It means a move down to that 200-day moving average could be quite swift if immediate support around 0.6480 fails. It's like a slippery slope with few handholds right now.
Okay, let's summarize the forecast for IU20.
Our forecast is bearish. Confidence is pretty high, 8 out of 10. 0.6400, 0.510. Watching that 0.640 level and the 200-day MA is key.
Got it. Okay, let's move on to USD CAD, the tariff tug-of-war. This pair sounds like a really fascinating conflict between Canada's domestic economic strength and those powerful external threats from U.S. tariffs. What's the technical setup for this currency battle?
Yeah, USD CAD is really interesting right now. Technically, it's coiled in a consolidation pattern just below a critical resistance zone. It looks like it's suggesting an imminent breakout higher.
Coiled like a spring.
Kind of, yeah. It's trading within an embedded channel, and it's striving to stabilize above the 20-day exponential moving average, the EMA, which is at 1.3682.
What does that signal?
It signaled the near-term trend is turning bullish. The daily RSI is up at 73.45, showing strong buying pressure. MACD shows a bullish crossover.
Any other signs of a potential breakout?
Importantly, the Bollinger Bands are beginning to widen. That often precedes a significant price move, an expansion of volatility.
And what are those critical levels to watch, particularly if we're expecting a breakout to the upside?
Okay, immediate resistance is the 1.3729, 1.3750 zone. That's the first hurdle.
And above that?
A critical hurdle for bulls will be getting a daily close above the June high and also the 61.8% Fibonacci retracement level. That confluence sits around 1.379598. That's the key breakout level.
And support if it fails.
Support is down at 1.3670, which is the recent weekly low.
Okay, this is where it gets really interesting fundamentally. How does Canada's recent robust economic data clash with these looming U.S. tariff threats? You called it a genuine tug of war.
It absolutely is. The Canadian economy, on its own, has shown robust health. The latest jobs report added a significant 83,100 jobs.
That's a very strong number for Canada.
Huge number. This reduces pressure on the Bank of Canada, the BOGOC, to cut rates, which would typically support the Canadian dollar, the loonie.
So domestic economy is strong, CAD should be strong.
Normally, yes. However, this domestic strength is completely overshadowed by the threat of a potential 35% tariff on Canadian exports to the U.S.
35%, that's huge.
Massive. That would severely damage Canada's economy, which is heavily reliant on U.S. trade, and would almost certainly force the BOC into easing its monetary policy, despite the current strength.
So the tariff threat trumps the good data.
This profound uncertainty weighs heavily on the CAD right now. Meanwhile, the USD benefits from its own resilient economy and that cautious Fed. Plus, subdued oil prices also don't help the loonie, adding another layer of pressure.
And what are institutions betting on for the Canadian dollar in this complex situation? Are they aligned on a particular direction, like we saw with the Aussie?
Yes, there's a very clear alignment here, too. Both leverage funds, they're short over 28,000 contracts. And asset managers short over 42,000 contracts are significantly net short the Canadian dollar in the latest COT report.
Both speculative and institutional money betting against the CAD.
Exactly. This agreement provides a strong quantitative tailwind for a higher USD CADs. They expect the US dollar to strengthen against the Canadian dollar.
What's the current velocity of this trend? Is the momentum building for that breakout you mentioned?
The short-term cycle has shifted decisively towards a bullish momentum phase.
How's the performance look?
While it was up only plus 0.26% over the last 30 days, reflecting that consolidation, it gained plus 0.63% in the last 7 days alone.
So accelerating upwards.
Yes, the pair is actively breaking out of that consolidation range, which strongly favors trend-following strategies right now, looking for that move higher.
How does sentiment play into this tug of war? What's the general mood among traders for USD CAD?
Sentiment for USD CAD is strongly bullish. It matches the technicals and positioning.
Any specific data?
ONDA's position ratio shows a staggering 78.53% of retail client accounts are long USD CAD.
Wow, nearly 80% long. Is that contrarian?
In this case, it actually seems to be acting as a momentum-confirming signal. The retail crowd is jumping on the bullish bandwagon here.
What else?
Social media highlights the tariff pressures, the general US dollar strength, and those bullish technicals. The strong DXY and an overall risk-averse tone are also very supportive of a stronger USD against the CAD.
And what do the AI models predict for this potential breakout? Are they confirming these bullish signals we're seeing everywhere else?
Yes, the models are aligned too. Monte Carlo simulations show a high probability of breaking above that initial 1.3750 resistance.
And then targeting.
And targeting the 1.3800, 1.3850 area. Bayesian models assign a high probability to a sustained USD CAD uptrend.
What about order flow? Any signs of a squeeze?
The order flow analysis reveals a significant cluster of stop-loss orders sitting just above 1.3750 and 1.3800.
Stops from people who are short.
Exactly. This is key because if triggered, these stops could fuel a short squeeze where short sellers are forced to buy back, pushing prices up rapidly.
And is there support below?
Yes. Buy orders are visible around the 1.3670, 1.370 area, providing some underlying support if it dips first.
Okay, forecast for USD CAD.
Our forecast is bullish. Confidence is high again, 8 out of 10.
Potential price zone.
1.3700, 1.3850.
Yeah.
Looking for that breakout above 1.38.
Great.
Nusria.
Finally, let's talk about USDMXN, the geopolitical proxy. Our source describes this as a pure play on geopolitical developments.
What's the dramatic technical shift we're seeing here? This one seems very event-driven.
It really is. This pair is showing clear signs of a major trend reversal, and it's happened quite dramatically.
What specifically on the chart? On the daily chart, the price has decisively broken above a key descending trend line. This trend line had defined its downtrend for weeks.
So breaking the downtrend.
Exactly. That's a significant technical development. Plus, the Mason-Dixon histogram has crossed above zero, and the RSI has rebounded sharply from oversold conditions.
So momentum shifting bullish.
The market structure is transitioning from clearly bearish to neutral, with a strong potential to become fully bullish very soon. The tide seems to be turning.
And what are the critical levels to watch, particularly as it shifts direction so dramatically?
Okay, critical resistance is now at 18.85. That's where that broken trend line sits. It might act as resistance initially.
And the next target above that?
The next major target is the psychological 19.0 level,
Hmm.
big round number again. Key support is back down at the psychological 18.50 level.
This sounds like a story driven almost entirely by headlines. What's the geopolitical narrative that's truly driving this significant shift for USDMXN?
You're absolutely right. The fundamental driver for USDMXN is almost entirely geopolitical. Specifically, the escalating U.S.-Mexico trade tensions.
What happened recently?
The Mexican peso, the MXN, came under severe selling pressure following announcements of a new wave of potential U.S. tariffs.
How badly could these hit Mexico?
They could directly impact Mexico's export-driven economy. A staggering 80% of its exports go to the U.S.
80%. Wow.
Yeah. Mexican President Claudia Sheinbaum has called these tariffs unfair and disruptive. And if no agreement is reached before the August 1st deadline,
The pressure intensifies.
selling pressure on the peso will likely intensify dramatically. The U.S. dollar, in contrast, benefits from this uncertainty, acting as a regional safe haven asset. Money flows out of an XN to USD.
How dramatically has the short-term cycle changed for USDMXN? It sounds like a complete flip based on this news.
It has undergone a profound shift. While it was actually down minus 0.68% over the last 30 days, reflecting the tail end of that old bearish trend,
Yeah.
the last week has seen a strong positive gain as the tariff news broke. The market has moved from bearish conviction to high uncertainty and outright bullish speculation in a very short period. It turned on a dime.
And what's the sentiment telling us for a pair so sensitive to breaking news like this?
Sentiment has flipped aggressively to bullish, driven almost entirely by this trade war narrative.
Where are you seeing that?
Social media, trader forums, they are alight with negative discussions for the Mexican peso and conversely, positive ones for USDMXNT. Analyst commentary focuses intently on the peso's vulnerability right now.
Retail traders joining in.
Retail sentiment also shows a surge in bullish sentiment, aligning with this new momentum. And generally, capital tends to flee emerging market currencies like the peso in favor of the dollar during localized geopolitical stress. We're seeing that classic playbook unfold now.
What about the AI and order flow analysis for this high-risk, high-reward situation? Can the models give us any clarity in such an unpredictable, headline-driven environment?
Well, Monte Carlo simulations, which are particularly useful for this kind of event-driven volatility, show a wide distribution of possible outcomes reflecting the uncertainty.
But is there a skew?
Yes, there's a clear skew towards the upside. It indicates a high probability of testing that 19.00000 psychological level.
And Bayesian models?
They have drastically increased the probability of a trade war escalation scenario being the dominant driver.
What about order flow? Did the breakout clear stops?
Order flow suggests the initial breakout above the trend line triggered a cascade of stop loss orders from short sellers, which definitely fueled that initial rally higher.
Where's the next resistance based on orders? And support?
The next significant resistance appears to be right at 19.00.
Awesome.
Meanwhile, a pool of buy orders seems to be forming around the broken trend line area, roughly 18.60, 18.70. That might offer support on any dips.
Okay, let's wrap USDMXN with the forecast.
Our forecast is bullish. Confidence is 7 out of 10, mainly because it's so headline dependent.
Potential price zone?
18.65, 19.00. But really emphasize this. This pair is highly dependent on unpredictable political headlines. Things could change very quickly.
Absolutely. Okay, now, for you, the listener who wants to turn all this knowledge into action, we've identified a high-conviction strategy. This is based on our integrated analysis for the USD pair. It's about taking the insights we've shared and seeing how they could potentially play out in the market.
Right. This strategy aims to capitalize on that strong, established bearish momentum we discussed in USD, while seeking an optimal entry point with what looks like a favorable risk-reward profile.
Okay, lay it out for us. Currency pair, USD, direction. Short, meaning betting the euro will weaken against the dollar. Okay, short USD. Entry price. We're looking at 1.16 narrow. Why 1.16 narrow specifically?
The idea here is to short the pair on a potential corrective bounce into a key resistance area, specifically where that recent broken support level and the daily S1 and pivot point converge. It gives us a strong technical point of reference for entry.
Okay, shorting into resistance. Makes sense. Where's the target? Take profit. 1.1510, just above that big 1.1500 level.
Exactly. Set just ahead of the major psychological 1.1500 level,
Yeah.
which we've identified as a significant liquidity pool and a likely magnet for the current downtrend, taking profit just before it gets there.
And crucially, the stop loss. Where do you get out if you're wrong? Stop loss, SL, 1.1660.
Why there?
This is placed safely above the broken multi-month trend line and also above the daily pivot point. If price gets back above this level, it would effectively invalidate our bearish thesis. It would signal our analysis might be incorrect, and it's time to exit the trade and limit the loss.
And the risk-reward on that trade setup, risk-reward, our ratio. This setup offers a 2.0 risk-to-reward ratio, meaning
Meaning it offers a potential 100 pip reward from 1.1610 down to 1.1510 for taking a 50 pip risk from 1.1610 up to 1.1660, 2-to-1 potential gain versus loss.
Okay, and the important disclaimer here.
Absolutely. Remember, this strategy is for informational and educational purposes only.
It's not investment advice. Not at all. Any financial decisions you make should always be with careful consideration, thorough research on your own part, and a clear understanding of the inherent risks involved in trading. Please be careful.
Well said. Wow. What an incredibly insightful deep dive today. We've just navigated some really complex currents in the global currency markets, didn't we? All driven by this central theme, the great divergence.
We really did. And we've seen how U.S. protectionist tariffs aren't just isolated trade disputes. They're profoundly reshaping global monetary policy. They're forcing central banks worldwide to take dramatically different paths.
And this crash is creating fascinating high-stakes movements in the currency markets.
Exactly, with the U.S. dollar being pulled in conflicting directions, truly acting as the very epicenter of this whole financial shift.
You know, the beauty of this kind of analysis, I think, is seeing how every single piece of information connects. From a central bank's, cautious statement to the nuanced signals from a sentiment indicator or even an AI simulation.
It all fits together.
It all connects to paint this vibrant, dynamic picture of an interconnected financial world. It's fascinating.
And this raises, I think, an important question for you, our listener, to take away.
What's that?
Consider how geopolitical events, like these trade disputes we've been talking about, don't just impact distant headlines.
Right, they're not abstract.
No, they ripple through the entire global economy. They directly influence things like currency values, which we focused on today, but even the costs of goods you buy every single day.
So the question for the listener is,
how might you apply this deeper understanding, this idea of interconnectedness and divergence, to observe future market shifts, whether that's in your own investments perhaps, or simply to better understand the world around you and how it's constantly changing?
That's a great point. Keep exploring, keep questioning, and keep connecting the dots. That's really how you truly become well-informed in this complex world.